Silver has had one of the wildest moves in the commodity market. It started 2025 around the low $30 range, it moved into the high 40s by autumn, and then the market just went vertical. By late January 2026, silver had traded above $120 per ounce during the frenzy. Since then, it has corrected sharply. But here's the important part: the structural story did not disappear. So today, we are looking at three stocks, three different ways to play that silver story. Because the market is still expected to record its sixth consecutive annual deficit in 2026. So the question is not simply, can silver go higher? The better question is, which companies can benefit most from this tight market? Because silver mining stocks are not silver bars. They come with costs, they come with politics, but they also come with operational leverage. Before we jump into stock names, we need to explain one thing. The silver thesis has two sides. The first side is monetary. Silver is a precious metal. It benefits when investors worry about inflation, geopolitics, or interest rates. That part of the story is similar to gold. But the second side is different. Silver is also an industrial metal. It is used in solar panels, electric vehicles, semiconductors, and increasingly in strategic technologies. This dual identity is what makes silver interesting. It trades like a precious metal when fear rises, but it also has industrial demand that keeps pulling metal into real-world use. That is why the deficit matters. The industrial demand stayed historically high in 2025 at roughly 657 million ounces. At the same time, net silver investment demand surged to 278 million ounces, while mine supply reached almost 847 million ounces. So this was not a simple industrial demand story anymore. It became a story about investment inflows, physical tightness, and shrinking available inventories. That is a powerful combination, and since 2021, roughly 762 million ounces have been drawn from inventories. Here's the key fact most people miss. Silver supply does not respond cleanly to the silver price. Why? Because most silver is not mined from primary silver mines. In 2025, only about 26% of mine supply came from primary silver mines. The other 74% came as a byproduct of mining other metals like copper, zinc, and gold. That changes everything. If copper miners are not expanding, silver supply does not automatically rise just because silver is up. If zinc or gold projects are delayed, silver supply is delayed too. That is why this episode is not just about silver stocks, it is about the quality of silver exposure. One of our three picks gives you direct leverage, the other gives you diversified exposure, and the last one is a copper company with a silver bonus. That is the framework for the whole video. So why even look at miners? Why not just buy silver? The answer is operating leverage. When silver rises, a miner's revenue per ounce can move quickly. But many costs move more slowly. Labor, equipment, energy, and processing costs. These do rise, but not always at the same speed as the metal price. That means margins can expand much faster than the silver price itself. When silver rises, miners do not just get a bit better. They can become dramatically more profitable. But there is a catch. Not every silver miner is really a silver miner. So in this video, the real question is, which companies give us the best silver exposure? Before going deeper, here is the short version. Fresnillo is the primary silver leverage name. It is the world's largest producer, and its operations are concentrated in Mexico. Pan American Silver is the diversified America's name. It combines silver exposure with gold, multiple jurisdictions, and a stronger growth angle after the recent acquisition. KGHM is the copper giant with hidden silver scale. It is not a pure silver stock, but it is still the most important producer in Europe. That is the framework. Not hype, not silver is going up, buy anything. Just one question. Who actually captures the upside from silver's deficit? The first name is Fresnillo. It is listed on the London Stock Exchange, but its headquarters are in Mexico City. If you want the cleanest exposure, it is the obvious starting point. It is the world's largest primary silver producer, and also Mexico's largest gold producer. Its operating mines are all in Mexico, including Fresnillo, one of the world's longest continuously operated mines, producing silver for more than 5 centuries. The geography matters, because Mexico is the most important silver jurisdiction in the world, and Fresnillo sits directly on that history. In 2025, it produced about 48.7 million ounces of silver and around 600,000 ounces of gold. Financially, the year was very strong. Revenue was about $4.6 billion, EBITDA was about $2.8 billion, and the company ended the year with a net cash position of about $1.9 billion. That gives Fresnillo a very clean role in this basket. It is the silver leverage name, not because it is perfect, but because it is one of the few large listed producers where silver really matters. Silver represents roughly 45% of Fresnillo's revenue exposure. It may seem low, but it is actually the highest percentage among all major listed producers. And there is another important point. Fresnillo is also a major gold producer. That gives the company a second precious metals leg. In a bull market for both silver and gold, that can be powerful. So the Fresnillo thesis is simple. It is the cleanest large-cap silver leverage name with a strong balance sheet and a deep Mexican operating base. The risk is that Mexico also concentrates the exposure. If labor, security, taxes, or politics become a problem, the company feels it directly. So Fresnillo gives us the cleanest silver leverage in the most important silver-producing country, but pure exposure is not always the best risk-reward. Sometimes the stronger setup is a company with more geographical diversification. That brings us to Pan American Silver. It is based in Vancouver, but with operations across Latin America. It is not the purest silver play, but it may be the safer one. The company has operated in the Americas for more than 3 decades, with a portfolio of silver and gold mines across multiple jurisdictions. Mining can get messy. In this industry, communities, politics, and the environment all matter. A diversified operating base does not remove those risks, but it does reduce dependence on a single mine or a single country. A diversified operating base does not remove those risks, but it does reduce dependence on a single mine or a single country. In 2025, Pan American produced about 22.8 million ounces of silver. Its all-in sustaining cost was only $13.88 per ounce. And financially, the company had about $1.3 billion in cash against roughly $850 million of debt. The most important recent development is the acquisition of MAG Silver. That deal gave Pan American a 44% joint venture interest in the high-grade Juanicipio mine in Mexico, which sits on one of the most important silver belts in the world. This is a big deal. It gives Pan American exposure to one of the best new silver assets in the sector, without making the entire company dependent on it. So Pan American is not the highest torque name, but it has the best balance between silver exposure, diversification, and financial strength. That is why I would frame Pan American as the risk-adjusted silver growth name. It benefits from higher silver prices. It has exposure across the Americas, which makes it less dependent on any single jurisdiction. But there is a trade-off, because Pan American is primarily a gold producer, and the silver exposure is diluted. According to our estimates, silver represents roughly 30% of the company's revenue. That is meaningful, but it is not pure, so the Pan American thesis is less direct silver leverage than Fresnillo, but a broader, more diversified way to own the silver cycle. Now we get to the most interesting twist in the episode. The biggest silver mine in the world is not a classic silver mine. It is actually a copper system. It belongs to KGHM, headquartered in the small city of Lublin in western Poland. It is not really a silver stock, it is a copper company with massive silver byproduct production. Its core operations are in Poland, in the deep copper belt of the Lower Silesian region. The World Silver Survey ranked KGHM Consolidated as the world's largest silver mine category, with around 41.1 million ounces produced in 2025. The company also has international assets in Chile, the United States, and Canada, but the heart of the story is Poland. In total, KGHM produced 43 million ounces of silver in 2025. That makes it one of the world's largest silver producers, and the most important silver producer in Europe. This strategically important giant is still controlled by the Polish government, which owns over 30% of the company. However, KGHM is not a pure silver play. The company's economics are driven mainly by copper. Silver helps. It can reduce unit costs through byproduct credits. It can improve cash flow when precious metals are strong, but the stock will usually trade more like a copper and Poland story than a pure silver story. Last year, silver contributed roughly 17% of KGHM's revenue exposure, while copper contributed about 67%. Its main market is Central and Eastern Europe, with more than 45% of revenue coming from the region. So with KGHM, you are not buying pure silver leverage, you are buying a strategic European copper producer with one of the largest silver byproduct streams in the world. That can be very attractive, especially if both copper and silver remain strong. But if silver rallies alone, while copper weakens, KGHM may not give you the torque you expect. So let's reduce it. Why these three? Because each one gives you a different version of the silver thesis. Fresnillo is the direct leverage name. It has the strongest silver exposure in this basket and the largest primary silver profile. Pan American Silver is the balanced growth name. It gives you silver exposure, diversification, and a major new catalyst through the MAG Silver acquisition. KGHM is the hidden scale name. It is not a pure silver company, but it is one of the largest silver producers in the world and the key European name in this group. So this is not one trade, it is 3 different trades. That is a much stronger framework than simply saying silver is going up, buy miners. Now let's focus on why the setup could work. First, the structural deficit is still there. The silver market is expected to stay in deficit for a 6th straight year in 2026, even after the extreme volatility of the last year. Second, supply is constrained by the byproduct structure. If 74% of mine supply comes from non-primary silver mines, then silver cannot simply call up new production the way oil or copper sometimes can. Third, industrial demand remains strategically important. Silver is essential in electronics, energy systems, vehicles, semiconductors, and high-reliability applications. Fourth, silver has gained policy relevance. In 2025, the United States added silver to its final critical minerals list. And fifth, miners can generate operating leverage. If silver stays elevated, the companies with real silver exposure can see margins expand faster than the metal price. That is the upside, higher silver flowing through fixed cost mining assets. That is the equity story. First, silver is extremely volatile. The move from late 2025 into January 2026 was not a calm bull market. It was a squeeze, then a sharp correction. Mining equities can get hit hard when the metal turns. Second, high prices can destroy demand. Jewelry, silverware, physical investment, and some industrial users can pull back when silver gets too expensive. Third, technology can reduce silver intensity, and solar manufacturers are still working on thrifting and substitution. Fourth, miners are businesses, not metals. Energy matters, currency matters, taxes matter. And fifth, silver exposure is not always pure. KGHM may produce a huge amount of silver, but it is mainly a copper company. Pan American has meaningful silver exposure, but also major gold exposure. Even Fresnillo has a large gold leg. So investors need to understand what they actually own, not the label, but the revenue exposure. So here's the thesis in one line. Silver is in a structural deficit, but silver miners are not all the same trade. The metal has rallied violently, the market has corrected, but the deficit, inventory drawdown, and the byproduct supply problem remain. That is why the mining stocks are interesting. So my ranking framework is simple. Fresnillo is the direct silver leverage name. Pan American Silver is the balanced growth name. KGHM is the hidden silver giant. Not every silver stock benefits equally, and in a market this volatile, that distinction matters. This is capital rotation. We look for the capital flows behind the headlines.